So it's been a lot of confusions, right, and a lot of just unnecessary gossip about a fair value gap. Fair value gap is a three candlestick pattern, right? You have one here, two here, there's displacement candle here, and then three, this candle here. So it's a three candlestick pattern, right? To where the first wick, this wick, and the third wick do not touch, and it leaves a gap in between. So this is how you draw it out. You want to go to your rectangle tool and you will draw from the first candle's wick all the way down to the third candle's wick, right? And then you extend that. This is a fair value gap. Remember, it's a three candlestick pattern, right? One, two, three, to where the first candlestick wick and the third candlestick wick do not touch, and it leaves a gap in between price, which is an imbalance, right? So you will want to wait for price action to come back into the imbalance, back into the fair value gap, and to expand lower. Just how we get here. You see, right, the TP. So if we will use this in a market replay situation, this is how it will look. Right, so this is our target. It creates the fair value gap. I'm going to go short. Once it comes into the fair value gap, stop loss above the fair value gap, targeting here. You want to make sure you have a good risk to reward. This trade risk, this is a 2.9 risk to reward. We're risking 25 points to make 74 points. So let's go. Sorry, we're short. Stop loss above. TP underneath. Let's press play. See how it comes back into the fair value gap. Now, you can't expect it to just run away right away. So you see how the first time it came to it, you're waiting on the change in the state, right? The first time, you see here, we did not get a close below this low. But this time, we did definitely got a close below this low, creating the change in the state of delivery. Wow. So when price comes right back to the change in the state of delivery, we're expecting it to, remember, the most sensitive part of the change in the state of delivery, aka order block, is from the low wick to the opening price. So you see how it comes up here and then expand lower. If you want to, you can look at, you can draw your fib. So let me just move this on to the left. You can draw your fib to the low and then to the high of the change in the state, aka order block. And the order blocks that's most valid, it do not come to the 50% range. So you see how it stopped at the 25% range and it just displaced lower, creating another fair value gap, which is a high probability trade. The change in the states, the one that creates the fair value gap, is a high probability trade. You see here, it did the exact same thing. So that's how you use a fair value gap coupled with a change in the state of delivery, aka order block. Now, this is ICT concepts. If you trade regular breakout patterns and bull flag, bear flags, bullish engulfings, break and retest, the 15-minute orb, those things like that, you may not understand these type of smart money concepts. So I'm not talking to you guys. This is only for the smart money traders, right? So appreciate y'all for tuning in. Let's get it.